Welcome to the Opening Bell Report.
Financially speaking, what we saw today was a massacre.
A total massacre.
It is Tuesday, January 20, 2026. And if you were anywhere near the commodities market, or even just glanced at the tickers this morning, you saw something that, well, probably made you do a double take.
A double take, then a triple take. It wasn't just a red arrow, it was a cliff.
We are talking about the ProShares Ultra Short Bloomberg Natural Gas ETF. The ticker is KOLD. KOLD.
Right.
And cold is probably how a lot of portfolios are feeling, because this thing didn't just slide. It dropped 38.35% in a single trading session.
Almost 40% of its value just evaporated in 6.5 hours. I mean, calling it a bad day is doing it a massive disservice. This is a historic technical failure.
Right.
It's the kind of move that wipes out accounts. It ends careers. This is what they write textbooks about.
And that is exactly why we're here. We're not just going to, gawk at the wreckage. We have a comprehensive analysis report on the desk here called Anatomy of a Breakdown. And our mission for this deep dive is to perform an autopsy on this chart. We need to understand how the machine broke.
Exactly. Whether you trade natural gas, which, by the way, is a wild beast, often called the widowmaker, or you're just fascinated by how market mechanics can snap, this is a masterclass. We need to dissect the gap, the psychology of the trap.
And the math. The brutal math.
Oh, yeah. The brutal math of leveraged ETFs that makes recovery from a day like this nearly impossible.
So let's get into it. Let's start at the scene of the crime, the opening bell. To really grasp the violence of this move, we have to look at the setup. Where were we yesterday?
Well, the setup looks innocent enough, actually, pretty standard. The previous close, where KLD finished trading yesterday, was $45.24.
Okay, $45.24.
That was the price on the screen. Traders went to bed. They probably felt, okay, a little nervous about the weather, maybe, but $45.24 was the reality.
$45.24. Okay, listener, keep that number in your head.
Yeah.
Because this morning, the market did not open at $45. It didn't even crash to $40. It opened at $29.90.
Just let that sink in for a second. That is a drop of $15.34, the literal second trading began.
It skipped everything. I mean, as a trader, you're used to watching something tick down, right? You see 45, then 44.8, $44.50. You have a chance to react. You can panic, sure, but you can at least click a button.
This was teleportation.
Yeah.
Precisely. In technical analysis, we call this a breakaway gap. Now, gaps happen all the time, but a gap of this magnitude, negative 34% at the open, that is incredibly rare.
So it's not just noise.
No, it's a signal, a violent one. The market is basically saying, yesterday's price was a lie. This is the new reality. Take it or leave it.
And I want to dig into that moment because a lot of responsible traders use stop losses. They say, okay, I bought at $45. If it hits $40, sell me out. They think they have a safety net. What happens to those people?
And that's the tragedy of the gap. That is the trap. If you had a stop loss at $40 or $38 or even $35, it never triggered.
It just jumped over it.
It jumped right over them. It's like setting a trap on the second floor of a building and the elevator drops straight to the basement. Your sell order executes at the first available price, which was $29.90.
That is terrifying. So you thought you were risking $5 and you woke up losing $15.
Instantly. You're instantly underwater. And this creates a very specific, very toxic market dynamic called overhead supply.
Okay, what's that?
Imagine thousands of traders who are now trapped. They're holding this bag of rocks. The dream of making a profit is gone. Now they're just praying for the price to bounce back to maybe $32, $33 so they can sell and just lose less money.
They just want the pain to stop.
Exactly. They become a wall of sellers. Anytime the price tries to rally, it runs into all these desperate people trying to get out. It just caps any potential for a real recovery.
Which perfectly explains what happened next, because after that horrific open, it didn't just keep going straight down. It tried to fight back, right? There was a pulse.
It did. We saw what we call a fake-out rally right after the open. The price actually pushed up to a high of $32.60.
Now, if I'm watching that, I might think, okay, deep breath.
Right.
The worst is over. Maybe I should buy more here to lower my average cost.
And that is exactly how the second wave of traders gets hurt. The analysis report points this out specifically. This wasn't genuine buying. It was likely short covering. Bears who made a fortune cashing out mixed with some naive dip buying.
People trying to catch the falling knife.
And they got cut. The rejection at $32.60 was swift. It hit that level and it failed hard. Once the short sellers were done buying, there were no real buyers left.
And the price just drifted lower all day.
All day. It closed at $27.89, near the very bottom. In technical terms, we call that a heavy close. It's a very bearish signal.
Because if there were buyers, they would have pushed it up before the bell.
Exactly. You would see a long wick at the bottom of the day's candle. That would suggest maybe a V-shaped recovery was forming. We saw none of that. Sellers were in control right until the end. The selling pressure is not exhausted.
This brings us to the fund itself. I really want to slow down here because KOLD isn't a normal stock. It's not like buying Apple. It has this nickname, the Widowmaker.
Yeah.
Why is it so dangerous?
This is the most critical part of this deep dive. KOLD is a derivative of a derivative. It's a negative 2x levered fund against natural gas.
Okay, derivative of a derivative. Break that down for us.
So at the base, you have natural gas futures, the actual commodity. Then you have this ETF, KOLD, which is a mathematical construct designed to move opposite to natural gas, but with double the leverage.
So if gas goes down 1%, KOLD should go up 2%. Sounds great.
It sounds great when it's working for you. But today, gas went way up.
And KOLD went way down.
But here's where the math gets brutal. It's something called beta slippage or volatility decay. It is the silent killer of these funds.
This is the part that's so counterintuitive. Most people think, I lose 38%, I just need a 38% gain to get back to even.
And that simple common sense thought is what bankrupts people. Percentages don't work that way from a lower base. Let's use the actual numbers from today.
Okay.
KLD dropped about 38%. It closed at $27.89. The previous close was $45.24. Now, to get from $27.89 back to $45.24, the fund needs to gain 61%.
Oof. Let me just repeat that. A 38% drop requires a 61% rally just to break even.
It's a mountain. And here's the kicker. Because KLD is -2x levered, for it to go up 61%, the underlying natural gas prices would need to crash by roughly 30%.
And gas is currently breaking out to new highs, so you're basically asking for a miracle.
It is statistically improbable, and this is why we say time is the enemy. Even if gas just chops sideways, KLD loses value because of daily rebalancing costs. The fund has to rehedge its position every single day, and in a volatile market, that's like being forced to buy high and sell low internally.
So it bleeds from 1,000 cuts, and it has this massive wound from today.
Correct. You don't marry these funds, you date them for about an hour.
And of course, you can't analyze KLD without looking at natural gas itself.
No, it's a mirror image. Natural gas likely smashed through a huge resistance level today, maybe $3.50 or $4. That resistance level for gas was acting as a support level for KLD.
So when gas broke through its ceiling,
KLD fell through its floor, it fell into the basement, and gas momentum is driven by physical realities, like the weather. It doesn't just turn around on a dime.
which is a perfect segue, the report outlines the new lines in the sand. The old map is useless, so where are the key levels now?
Right, the landscape has completely shifted.
Let's start at the top, the old close, $45.24.
The report calls this phantom resistance. It's a ghost level.
Why phantom?
Because of that leverage decay we just discussed, even if natural gas retraces its entire move, KLD won't get back to $45.24. It will be lower. So that price is a memory. It's in the past.
That is sobering. Okay, what about a more immediate ceiling?
That would be the intraday high from today, $32.60. Remember, that's where the fake-out rally failed.
The level where the dip buyers got crushed.
Exactly. That is a major scar on the chart. The bulls need to reclaim that level just to stop the bleeding. It's the line between hope and despair right now.
And the floor. Where's the safety net?
The current floor is today's low, $27.11. This is the danger zone.
Why is that number so important?
Because below $27.11, there's no recent price history. It's an air pocket. If it breaks that low, the stock enters price discovery mode.
Which means it's just falling and trying to find a bottom.
Yes, and panic usually means it searches much, much lower. Which brings us to the 52-week low,
Which is?
$16.21.
Well, wait, we're at $27 now? That's another, what, another 40% loss from here?
That's the magnet. If the $27.11 support breaks, there isn't much structure to stop it until it gets near $16. It's a slide, not a staircase.
So what does this all mean for the next few weeks? The report outlines 3 forward-looking scenarios. It's not about prediction, it's about preparation.
Exactly. Scenario A is the dead cat bounce.
A little morbid, but classic Wall Street lingo.
It refers to a temporary reflexive recovery in a dying asset. The report gives this a moderate probability.
And how would that play out?
Well, natural gas is volatile. It overextends. So if gas prices pull back a little tomorrow just from profit taking, KLD might pop back to that $30 or $32 zone.
And this is crucial. Is that a buy signal?
Absolutely not. The report is emphatic. This is a selling opportunity. It is an exit door, not an entrance. You take what's left of your capital and you run.
Got it. Don't get greedy. Okay, scenario B.
Scenario B is continuation. The probability here is listed as high.
The bad news scenario.
This is the one driven by fundamentals. The report mentions the polar vortex, where in late January, if the weather stays cold, physical gas buying will continue. Utilities have to buy no matter the price.
And technically, that means breaking the $27.11 support.
Yes. And the target for that move is a test of the $20 to $22 zone within the next 1 to 2 weeks.
Wow, that is fast.
Fear moves markets much faster than greed.
Okay, and finally, scenario C, consolidation. What if nothing happens? The market just goes sideways.
You might think that's safe. But remember the Widowmaker mechanics? Time is the enemy. Even if the price of gas stays perfectly flat for a week, KOLD bleeds value from those daily rebalancing costs and expense ratios.
So it's a slow death instead of a fast one.
It's like holding an ice cube in your hand. Even if you don't squeeze it, it's melting.
So really, looking at these three scenarios, the bounce, the crash, and the bleed, there isn't really a good outcome for anyone holding this right now.
Not unless the weather completely flips and we get a heat wave in January. The chart is broken. The report's conclusion is blunt.
Which is?
Avoid long positions. The trend is powerfully negative. The phrase they use is, the falling knife has not yet stuck into the floor.
Meaning don't try to catch it.
Let it hit the ground, let it settle, let it stop vibrating. We are nowhere near that stage yet. We are still in free fall.
You know, this whole deep dive really makes you think about the difference between, say, investing and just pure speculation.
It absolutely does. It's a reminder that knowing the instrument you're trading is just as important as knowing the market. You can be right about the direction and still lose everything if you use the wrong tool.
That's a profound point. We're looking at an asset that needs the underlying market to crash by 30% just to break even on a single day's loss. It raises a question for everyone listening, At that point, are you investing? Or are you just gambling on the weather with a deck that's stacked against you?
That's the $6 million question, isn't it? When the math requires a miracle, it's probably time to step back from the screen.
A huge thank you to our listener for requesting this. It was a sobering look at volatility, but sometimes the best lessons come from the hardest charts. We hope this autopsy helps you stay out of the morgue in the future. Stay safe out there, watch your leverage, and we'll catch you on the next deep dive.
Take care, everyone. Watch your stops.
Don't forget to like, share, and subscribe for more.